So welcome to Ivy League Academy. This is going to be my free trading course. A lot of people been hitting me up wanting to know like how I trade and or like how long I've been doing it or what to do and how to do. I try to explain it to them. They just like they get confused. So I figured I'd make a free trading course. This goes over about 80 to 90% of what I know about trading. Not including the ex- like in market experience, not including you know the 4 years that I've been doing this. Um, it's just pretty much fundamentals and basics of pretty much everything that I know about trading. Um, yeah, we probably gonna get started on a few of these slides though. I got a slideshow right here that I'm gonna go over. I'm gonna bring in the market and show y'all some scenarios that happens in the charts. So yeah, y'all just stay tuned on these little on this little series. Um, and yeah, let's go ahead and get started. So a little disclaimer: this is not a get rich quick scheme. You will lose money. I've lost tons of money, bro. Tons of money. You will lose money, time, and patience in these markets. Okay. I lost money for 3 years straight before I was able to say I am a profitable Forex trader. Okay, like I said, I've been doing this for 4 years. I started when COVID hit. That was my senior year in high school. I used to be on the school computer down looking at charts. Anyway, I sacrificed 9 to 5 jobs, relationships, and a hell of a lot of time to reach a financial free lifestyle. Okay, can I say I'm financially free? Financially free right now? No, I cannot. But the vision there, I'm already past that. You know what I'm saying? I'm already on that. So we ain't gonna talk about that though. That's nobody business. How is money made from these markets? Okay, so this is how the only way I could dumb it down for y'all on how the market allows us to get money from it. So let's say you had 10 US dollars, okay? This is the Forex market, by the way. If you had 10 US dollars, decided to exchange those dollars into, let's say, the Mexican peso, okay? You would receive 167 pesos, right? 167.42 pesos. If you were to exchange those same pesos back into US dollars, you're either going to get more than your original 10 or less than your original 10. Okay, so the market is a timestamp, or not timestamp, like a drawing of like how this market fluctuates. Okay, so if you get in at the right time, you're going to get more than your original $10. But if you get out at the wrong time, you're going to get less than your original $10. So it's all about implementing a strategy, correct timing, and a lot of experience when it comes to the market, bro. I hope I'm not throwing y'all off. I know it sounds like a lot of fugazi ass shit, but nah. It'll make sense if you just keep going with me, all right? So the basics. There's 9 times out of 10, there's gonna be two instruments or two platforms that you will be needing for this trading shit. Okay, Trading View is probably it's like the second most important. The other one is most important, but we're gonna get to that after this one. Trading View, okay? Trading View is the main platform for marking up your charts and making your daily analysis, okay? So this is the chart that I go to first. This is the chart that I'll be like, okay, boom, I'm about to this is where you implement your strategy. This is where you see this is Trading View. Let me just show y'all real quick. This is Trading View. This is the chart that we will be marking up on. This is a Forex chart. This is what a Forex chart looks like. Okay, I'm hoping y'all already know that because y'all over here learning how to do it. So I'm hoping y'all already know how this is. Okay, so let's see. This is the platform you would. Oh, I already said this. You'll be using your markups. This is the platform you'll be using to mark up your stop loss and take profit, and also applying your strategy, like I said. Okay. So let's go to the next. Brokers. Okay, this is another very important thing. Brokers. A broker is like a bank that holds your trading capital, the money you trade with. So this is the pretty much, like I said, a bank account. Without a broker, you cannot trade. You can start off with fake money, which is a demo account. This is recommended for when you are first starting. Do not start off with a $1,000 account because those are unrealistic numbers for beginners. Okay, so if you go look for a broker, look, I got recommended brokers right here: Hanko Trade, Sway Markets, and Osprey FX. Okay, I think all three of these have demo account options. So you have a live account and a demo account. Demo account's fake money before you go to your live account before you start losing your real money. Okay, so start off with that demo. It's like a practice. It's like a practice account. So recommended Hanko Trade, Sway Markets, and Osprey. Okay, these are brokers. Oh shit. Okay, I already put that there. ACT. Okay. So each broker uses different trading platforms. So the main two platforms, okay, is TradingView, which is where you do your markups, and the broker's platform on where you actually place the trade. So I mark up on TradingView, and my broker platform is 8cap. So those two platforms are the only platforms you will ever need to trade. Okay, so if you go to Hanko Trade Broker, they use the ACT Trader platform. If you go to Sway Markets, they use and the regulator, which is that means they're very good, a regulated broker. They use Sway Charts platform. Okay, Osprey FX uses Trade Locker platform. So depending on what broker you go to, all different. All depends on, like, it is different. What the fuck am I trying to say? It's each platform, each broker has a different platform they use to place your trade. That's what I was trying to say. I sound like a fucking retard. Okay, lot size, aka the boring stuff. This shit right here is boring. This is the I guess basics of the basics of the basics that really you don't even have to know, but just it's good to know. There are lot size calculators to calculate your risk per trade. So each trade placed, we'll get into that later. There's a lot size calculator. Remember that. Go ahead, write that down. There's a lot size calculator to calculate your risk per trade. I use the calculator from my FX books. Okay, points and pips. These are the calculations of each tick a candle makes. Okay, 1 pip equals 100 points. Let me show y'all what I mean by tick or a pip. So let's go to TradingView. Let's go to the minute chart. Well, let's go to here. Okay. So this number right here, each time this number moves, it moves by a tick, okay, or a pip, okay. So each time, let's say if it was go to 286, it went up 1 pip. If it was to go to 284, it went down 1 pip. Okay, let's find one that's actually moving. This one's actually moving. Okay, it's going up pips. Okay, now it's going down pips. Okay, so each pip is a tick calculating each move, whether it's going up or down. Okay, here we go. 1 pip equals 100 points. Okay, so you got points and you got pips. 1 pip is 100 points. 10 pips is 1,000 points. Okay, lot sizes. This is what you would. Oh shit. This is what you would be needing to calculate the trade that you take. Okay, so 0.01 lots equals $1 per pip. So each time this thing moves, okay, each time this thing moves, it's $1 per pip. So if you were to sell and it's going down each pip, you're calculating $1 for each move that it makes. Okay, that's at 0.01 lots. So let's say you raise your lots to 0.10 lots. Okay, that's $10 per pip. So each time it moves, right? Each time it moves, you're getting $10 for each tick. So 10, 20, 30. If it drops, 20. Drops again, that's 10. Then it goes back up. You know what I'm saying? So just this is how candles are going to be moving, whether it's going down or whether they're going up. Okay. And this is a 1 minute candle, so each candle represents 1 minute, which we'll get into that later. Okay. All right. And so on with so on. Oh shit. One lot is $100 per pip. So each time the candle moves, is calculated by 100. So if it goes up 3 pips, that's $300. If it goes down 3 pips, you're back at 0. Then if it goes below that, you're negative. Okay. And then so on with these. If you go 0.02, it's $2. 0.03 is $3 per pip. I hope y'all get that. If I don't really if I'm not explaining it to, if I'm not dumbing it down enough, please go to YouTube and look up what is a pip, what is a point. And hopefully you'll get a better understanding, or you could just rewatch this video and you'll understand. Okay. So another important thing is a stop loss and a take profit. Let's say you set a stop loss of 10 pips, which is 1,000 points, with a 0.1 lots. That means you are willing to risk $10 on the trade. Okay. So this is going over stop losses and take profits. Okay. So let's say we do a sell right here. Boom. Okay, this is a sell and this is a buy. Okay, these are all tools that are on TradingView. TradingView has multiple tools. They have all these. You can favorite them and they'll be in your favorite bar, which is these are the main ones that I use. You can do call outs. Boom, boom. You could do your rectangles. You can mark up a supply zone, which you probably don't know what that is. You can mark out key levels. You can mark out boom liquidity. You don't know what that is, which we're getting into. You can do lines, bro. There's so many tools that's on this. That's why I mark up with TradingView. Okay. But this right here is a sell position. Okay, if you hover over it, it'll tell you short position, sell position, same thing. This one is a long. So let's say you're in a short position. This is where stop loss and take profit goes into place. Okay. Let's say we have a stop loss of 10 pips, which this is pretty big. So let's go to the 5 minute. If it was at 10 pips, we'd be risking $10. Okay. And if it was at 5 pips, we'd be risking $5. Okay. So starting off, I'd rather a lot of y'all traders use 0.01 lot size, if not 0.05 lots, to get a little feel of realistic numbers. Because if you're throwing 10 lots on that thing and you get lucky and hit a win and you see, oh, I won $13,000, it's just not going to be real. So help yourself by using low lots and a smaller account to get a hint of how this shit works. Okay, if you start off with unrealistic things, bro, you will get unrealistic results. Okay, so that's what the stop loss. Stop loss. Okay, so if you have the same 10 pips at a higher stop loss, at higher lots, you would risk higher on the trade. Okay, vice versa would take profit. So the green would be take profit. Okay, the green is take profit. So that's why it's a sell. If it was a buy, it'd just be flipped. Red is your risk, green is your take profit. Okay, that's how much you're in profit for. Right now, this is a little fake trade. I'm not in a trade. You can move it around. But let's say, boom, let's get rid of that. Place a buy, boom, 10 pip stop loss. We're risking, what was it, $10? Yeah, risking $10 on this trade. And our take profit is also 10 pips, which meaning we're risking $10 to receive $10 as a win. Okay, that's if you win. This is not 100% win, bro. No such thing. So same thing with take profit. If we were to hit a 10 pip profit, we'll receive $10. If we were to go for 12 pip or 13 pips, we'll receive $13 at a 0.01 lot size. Okay, so if we were to raise that lot size to 0.10, y'all need to like this. This need to be written down right here. I'm not gonna lie. So if we were to put our lot size at 0.10, our reward will be $100. Okay. Oh yeah, my bad. So at a 0.10 lot, our reward would be 100, and our risk would be 100. That's if you're going for a 1-to-1. So we're risking 10 pips to receive 10 pips. That means we're risking $100 to receive $100, and so on and so on with the lot sizes. Okay. Next segment, because that was a lot. Remember, if there is no risk, there will be no reward. Okay. Risk to reward, also called R to R. Okay. Your risk to reward is used to make sure you are always winning more than you are losing. It is set to prevent you from losing more money than you win. Okay. I typically target a 1-to-1 risk to reward ratio on majority of trades depending on market conditions. This means if I were to risk $100 on a trade, my reward will match that at $100. Okay. When you're going for a 1-to-2 risk to reward ratio, this means if you were to risk $100 on a trade, your reward would be $200 because of the second number switch. If you were to go for a 1-to-3, and you risk $100, your reward would be a $300 if you win. Okay. Anything less to a 1-to-1 is not ideal, and you most likely will not be profitable. So anything less than let's say you're risking 10 pips to get 5 pips, that's not ideal. That's no good. And you'll see it right here, risk to reward ratio. So it's a 0.5. A 1-to-1 will look like this. A 1-to-2 will look like this. Like that right there. Okay. So I typically go for a 1-to-1 to a 1-to-2. So I like the 1-to-2s because if you win 2 trades and you lose 1 trade, you're profitable still. Okay. It'd be like you went for a 1-to-1. Like I say, anything less than a 1-to-1 is not ideal. I don't suggest that. Candlesticks. This is the last thing, the last section for our basics. Candlesticks, OHLC. O stands for the open of a candlestick. So we're here or here, depending on what kind of candlestick we got. So we have a bullish and a bearish candlestick. So our open would be here on a bullish. Our high would be here on a bullish candlestick. Our low would be here on a bullish candlestick, and a close, and our close will be here on the candlestick. Okay. On a bearish, our open, our high, our low, and our close. So it would start at the open. Typically, it would hit the low, go up, hit our high, and close here. Okay. Sometimes candlesticks be on some bullshit. They might open here, go high, low, high again, close here. Okay. But these are all important. These are very important. A very important segment of learning the basics. Okay. This right here is called a wick. This right here is called a wick, and this is the body of a candlestick. Okay. So if you have an actual candle, the wax is the body, and the wick is the wick. Okay. So it's pretty self-explanatory. Here are patterns. They indicate markets momentum. We need a momentum market. We need volume in the market. We need candlesticks like this. That just means rejection. It shows rejection at a certain point. All right, and that's pretty much all I'm gonna go over on this section right here. I went over the intro and the basics. Y'all study these basics, bro, for real. Like study the basics before we even go to our next segment. Okay, introduction to the market. Don't go through the whole thing and an hour. Don't go through the whole course in an hour, bro. Study this piece by piece. Get it piece by piece. Treat it like, like you would a week at school or something. You get introduced to the little section at the beginning of the week, and by the end of the week you have your test. Okay, you should know everything throughout the week in order to take your test. All right, so treat this as, what I'm saying, as your little practice, like market. I mean, what the fuck am I talking about? As your homework. All right, this your homework. Okay. Like I said, if y'all got any questions, y'all can hit up the Telegram. The Telegram will be linked to my WAP account. So, or I think I posted this on YouTube too. So my Telegram will be in the description down below. So y'all go ahead and do y'all little homework on this shit. All right, man. I'll see y'all in the next section. The next section will be being introduced to the market. So I'll holler at y'all then. Y'all hold it down.